September was meant to be a very poor month in the market. That is ultimately what the data tells us. In fact, going as far back as 1928, September saw an average drawdown of around 1.2%. We were also hearing from analysts where they expected this September drawdown to be a jumbo effect, meaning very, very large, and that is not what we got at all. In fact, nearly every week we were hearing the markets, S&P 500, the Nasdaq, the Dow continue to climb to new all-time highs. And we're now hearing from the Bank of America analysts that what we're seeing across the market is a new normal. Investors should not be worried. This is not any sign of a bubble whatsoever. And to make matters even more interesting, we have a very, very strong record that the S&P currently holds. In fact, it has now gone 107 sessions without a drop of at least 2%, and this is the longest stretch it has seen in quite some time. Having said all of that, in just the last week, we are seeing the market start to cool off. We're seeing a lot of companies that were very strong historically start to turn red, and you can argue for a few reasons. The first one being, yes, we got interest rate cuts. Yes, Jerome Powell said there may be a few more to come by the end of the year, but it looks like, based on all the information that they have been receiving, this is something that, as he says in his own words, are not guaranteed, and that ultimately there is a challenging situation, so it's very difficult to predict what is going to happen, and that is what the market is slightly anxious about. And couple that with the fact that across the board valuations still continue to be high. We're looking at a forward P basis, we're looking at a price to sales, price to book across pretty much every single valuation indicator. There is a lot of red screaming right at investors. So perhaps it then makes sense why sentiment has started to pull back. For the first time in a long time, we are sitting in neutral, and even though September's predictions based on history didn't come into fruition, if you want some good news moving into October next week, if we go back to 1950, the last 20, the last 10, or even the last 5 years, the markets have looked fairly strong. We don't see the negativity from September's historical data, and we also got an increase from Goldman Sachs for the S&P, where they expect this to end. In fact, by the end of the year, they're calling it around 6,800 points. Now, not that much upside, we're only talking around 2% from where we closed, but there are also considerations to have. We can't just be very bullish, we have to look at the bear case scenario. We have Sam Altman saying last month there is a possibility that we're entering into an AI bubble, very similar market conditions in his opinion to the dot-com boom in the 1990s. And just remember, last week Nvidia declared they're investing up to $100 billion in OpenAI, which has got more and more analysts believing that it is very certain an AI bubble is about to burst, and very soon. One fact though that puts all of this into perspective, when we think about Nvidia, the world's most valuable company, not only is it that, but in fact it's worth more than 97% of the world's economies, as well as all of the world's military spending. Now that may not mean much to you as an investor, but it looks like valuations across the board, even when incorporating growth for a strong booming company like Nvidia, seem to be running out of hand. So today we're covering 6 stocks that we believe do show value for investors. We like each one of these, and we're going to discuss them in further detail. The first one, which we believe alongside both Wall Street and Quant is a strong buy, is in fact Amazon, seeking alpha with a respectable 4.21 out of 5. And we notice it is trading around the mid to upper end of the 52-week range. And whilst it is up 15% in the last year, year to date is flat. It is the worst performing Mag 7 company. It is lagging quite significantly. And whilst we'll discuss this, get to our valuation, we did do an in-depth dive not that long ago, so do check it out. Over the last 10 years, it is also one that has massively outperformed the S&P 500 and is also trading at a decade low. If you want to look at the EV to EBIT, around the 31.5 mark, the highest point in the last 5 years was well above 175. And yes, it does get a D on the valuation grade, which may be confusing if we're looking at a double strong buy, in fact a near strong buy as well from Seeking Alpha, because against the sector comparison on a forward P, you're paying an 83% premium, against their 5-year average an 81% discount, but actually one that probably is a bit more reasonable to look at for the company is the price to earnings growth, 1.88, which, as we always say, below 2 is one for some strong consideration. That is above the sector at 1.77, but this is the sector in a bucket. We would argue Amazon is a high quality company, not just in the sector, but also across the board. Now, their growth at an A- may not be the greatest when we're talking about a company with the strength only producing 10 to 11% revenue year on year. Yes, it is above the sector, which is very low single digit, and yes, they're growing slower than they have done in the last 5 years. One thing though that we do like is earnings per share expected to climb 18% over the next 3 to 5 years, above the sector at 11, but below the historical at 29. This is a company that is number one in the cloud computing market. We can see they brought in the latest quarter just under 30 billion, currently holding around 30%, in which the market itself grew 25% year on year. And one thing this company is doing, in fact more so than the Mag 7, is they're spending a lot. They call this a once in a lifetime opportunity for artificial intelligence. It was anticipated for the full year 100 billion. They've revised this upwards now to 120 billion, and they're spending a lot right across the board. They want to be incredibly more efficient. We're talking improvements to their margins, and that is something we are starting to see. In fact, going back a few years where it was at the lows of 3%, it now sits at 11%, and we do believe this will only continue to climb, especially because the company now has a significant number of robots that they're using to help reduce costs. In fact, more than 100 million. And what makes it even more fascinating, they nearly have more robots in their warehouses than humans, something we only expect to see change where more robots will in fact be used, less employees at least in their warehouses, which will ultimately translate more efficiencies, faster free cash flow growth, and ultimately bottom line, better shareholder return. Now, in terms of institutions, they hold 72% ownership, selling 76 billion within the last year. They bought a lot more same time frame, 227 billion, and they bought a lot more in quarter two. We're talking, in fact, around 6 times as much as they did sell. And yes, more often than not, institutions are buying a lot more shares than they are selling. But if you want to look at times where they bought a significant amount around the 90 billion mark, you'd have to go to Q4 2024 and then all the way to Q2 2022, really highlighting that institutions believe now is a great time to consider the company in your portfolio. Now, for each one of these companies, we will get to our intrinsic price, where for Amazon, using the DCF, we get to $228. We have our growth rate at 20%, where we have a low, medium, and high, 15, 20, 25 respectively. As always, numbers here are subjective. You can grab a copy of this model by clicking on the pinned comment below, running through your own numbers for Amazon or any others. Now, baked in on a reverse DCF is 19.4% moving forwards, and whilst you may look at these numbers and believe they are very high, just bear in mind in the more recent period they are spending a lot of money on capex, and we do anticipate these numbers to increase rapidly, and therefore maybe using 2024 multiplied by the growth rate isn't the most accurate starting position, as we do believe ultimately these numbers will start to accelerate at a very fast rate. Having said that, 20% with a discount rate gives us the present value of future free cash flow terminal price. Add together with the cash, subtract total debt, get to the equity value, divide by shares outstanding, 228, indicating 4% upside. If you believe that's too high, at 15%, $160, 27% downside. And if you believe we're being way too conservative, at 25, 322, 47%. As typical on the channel, we take through the middle rate at 20% today, which highlights you are right now getting a 4% margin of safety. Typically, we like to kick off with 10%, where we'd execute buy if it met our 3 criteria: wide moat, strong financial metrics, good forward-looking data. $205, great time to consider this company. Some investors, in fact, would be happy without a margin of safety and just dollar cost average, as it is a high quality company. As of today though, a 4% MOS is on offer to investors. Wall Street themselves, with the double strong buy rating that we saw including quant, 266 into next year, 21% upside. Let us know your thoughts on stock number 1, Amazon, today. Before we continue, just to let you know, we have released our latest free weekly article. We drop one every single Monday morning to your inbox, covering severely undervalued stocks as well as what's gone in the market over the last few days. So click below, you can sign up and read straight away, where you'll be able to gain access to severely undervalued stocks for the month of September. Lots of information for each one, the upside that Wall Street themselves see over the next year. We will be releasing October's copy in the next few days, and you can also grab a recently released copy of stocks that Wall Street themselves believe have the most upside in the S&P right now. So click below, you can sign up and read straight away. The next stock we're moving on to is in fact Visa. Now this one did have a dip. There were quite a number of companies that were talking about issuing their own stable coins, which would possibly circumvent the likes of Visa, MasterCard, and that did see a bit of a drop in their share price. However, now and unsurprisingly, it does look like Visa will incorporate this within their own systems, and therefore analysts do not believe this will have a significant impact on their business. Now we can note it is in fact down more than 10% from its all-time highs. We get a buy from Seeking Alpha, near strong buy from Wall Street, 4.35, would need to be 4.5. Decent run in the last year, up 24%. Year to date, not the greatest, up 7. Over the last 10 years, another outperformer. Now the forward P and in fact the yield aren't both too dissimilar from the 5-year averages, which does tell us it could be reasonably valued. And when we get to the blue tunnel, which as always highlights the expected fair price, again bang in the middle, another reasonable fair value signal. We do notice though pretty much in the last year it has been trading well within both of these regions, the upper and the lower end, but always great to see the intrinsic price increase over time. And in fact, if we zoom out to the last 5 years, it isn't that often that you do get to see the likes of a high quality company Visa trading in a severe undervalued signal. That is when the share price is below the bottom end. So as always, make sure you're subscribed, notification bell is on. High quality companies severely undervalued, we will let you know. Now on the valuation, where it does get an F, it is trading a lot higher in the sector. Not something we would say is comparable. It is a very high quality company. It is though trading very marginally at a discount on a price to earnings growth 2.25, well above the sector. Again, probably not something that is justified to look at, but against their own 5-year, it does sit around 12% higher. Now you are buying a very consistent company, at least historically. Expected over the next 4 quarters, double-digit growth to the EPS, 100% track record over the last 4, in fact beats every single time, and based on their next EPS estimate, forward P estimated to come down to 26.3, where growth is very consistent again. Last year grew 11%, expected the same this year, above the sector in comparison and pretty much in line with their own historicals. Earnings per share, fairly similar story at 13% projected, above the sector at 11 and just a little bit below historical 15.6. But one thing to bear in mind, this is an incredibly profitable company, A+, 98 gross profit margin, well above the sector, little improvement to their 5-year average. Bottom line, 52%. That is incredible to note. For every $1 of revenue, going straight to their bottom line is 52 cents, significantly higher than the sector, and again, very marginal efficiencies. Cash from operation, also huge, 23.5 billion. When you look at the last 5 years, 17.6. This company is only improving with time. And if we look at the institutions, 82% ownership, selling 41 billion. They bought around 50% as much in the same period, bought twice as much in quarter 2. They also bought a lot more in quarter 1. So you can clearly see this is a company time and time again, especially in the recent period, institutions themselves have been loading up on. Now our intrinsic price, $349 on the DCF again. We've used a growth rate of 12%, baked in just slightly lower at 11.5. If you use a 10% growth rate, then downside, higher rate at 14, 19% upside, and this gives rise to a marginal MOS very similar to Amazon at around 4%. If you wanted 10, well, a buy at around 314, at 20% at 280, and at 25 around the $262 mark. Wall Street still see this $400 into next year, 19% upside, so do let us know your views. And for those that believe we should go higher at 14%, well, we do sit around $402, pretty much in line with where Wall Street see this. giving rise to a 16% MOS, so let us know on Visa today. We then move on to Salesforce, a company that continues to come under question. Growth has started to slow down. Is artificial intelligence actually a benefit or on the contrary for the company? Now it's one that's trading right there near its 52-week low, huge way away from 52-week high. Double buy rating. We also get near strong buy from Wall Street, down 12% in the last year. Year to date, they've lost more than 1/4 of their total market cap, but still over the last 10 years, if you've been a longer term shareholder, you would have massively outperformed. We also see huge disparity, forward P20 well below the 5-year average of 30, so potentially a severe undervaluation signal. And that is what we do in fact notice when we take a look at this model, disparity between the lower end and today's price. And again, with Salesforce, we like to remind you intrinsically the blue tunnel has been decreasing for the most part. Something that when we zoom out to the last 5 years, we can note did peak pretty much around the beginning of 2024. But actually this is one that has consistently been in a severe undervaluation signal for quite some time. Something to consider about whether you believe in this company over the longer term, 5, 10, 15, 20 years. And valuation, it gets a D+. We're talking 15% discount to the sector, 44% discount to their 5-year average. Price to earnings growth looking very cheap, 1.2, well below the sector, 33% discount. But we're talking also on a PEG basis, 41% discount to their historical. They're also pretty consistent, projecting near enough double-digit growth over the next 4, 75% track record, last 3 have been beats. Forward P projected to drop into January 27 down to 19, where their growth has clearly started to slow down, 8% last year, 9% expected this year, a little bit above the sector, but again look, over the last 5 years they were growing at a faster rate. Earnings per share though pretty decent, expected 17 to 18, above the sector at 15, not too dissimilar from their historical just below 20. And institutions with their 80% ownership selling 28 billion, bought more again at 43 billion, bought more in Q2 and Q1. In fact, you'd have to go quite some way to see some disparity between the selling and buying. Q3 2023, so another institutional favorite, at least in the recent period. Now, our intrinsic price gets to $370, and this was using an 8% growth rate. We want to be very conservative using the low rate for CRM. Baked in is only 2.1%, so straight away you could look at this and say it's undervalued, and using the 8%, you're already getting a 34% margin of safety. Wall Street see this $365 into next year, 50% upside. Maybe you agree, maybe you disagree, do let us know. And if you think we're being way too conservative, well, at 10%, so the middle rate today, $425, you're getting a 43% margin of safety. We can go the other way and just cut it in half and say 4% instead of 8. You're still getting a margin of safety of 13%, so it does look attractive if you believe this company isn't going to die out due to AI. We then move on to Constellation Brands, a whopping negative 48% in the last year. Their market cap cut in half, year to date down 40%. Over the last 10 years, you pretty much would have the same amount you invested excluding dividends 10 years ago, trading at a 52-week low. Traffic light system, interesting hold from Seeking Alpha, strong sell from Quant, but Wall Street respectable buy, 4.04 out of 5, and we see them now at a 5-year low based on the data. Forward P 11.5, historically at 20, yield above 3%, historically at 1.4, and given the disparity in the yields, we do want to point out that the safety sits at 70 safe, but very disappointing. Most recent increase to the dividend in April was at 1%, well below inflation. And on the blue tunnel, very similar situation to what we got for Salesforce, intrinsically decreasing, but still a lot of disparity between the trading price today and the bottom end. And on the valuation, they get a C+, but you're getting a 27% discount to the sector, 42% to their 5-year average. But bear in mind, the issue with this company is their growth, flat last year, expecting a decline of 3% in fact in the next 12 months. Sector does sit higher, only just, but at least positive. Over the last 5 years, this company, in all fairness, was really only growing in line with inflation. Very important to understand if you're investing. Earnings per share is expected to decline, negative 2%, sector at 6, and their own 5-year, very, very strong in the past, above 8%. They're also expecting only one of the next 4 quarters to be growth, 50% track record historically. Most recent one was in fact a miss, where we notice earnings per share, yes, an increase a little bit over the next full year, lowering the forward P to 10.5. Now, institutions with their 77% ownership selling $6 billion bought more, just under $8 billion. They also bought around 50% more in quarter two, although the reverse of the trend is noted in Q3 2024. At least in the most recent period, institutions seem to have been buying the dip. And our intrinsic price gets to $184, the average of the three, which as always, you can grab a copy by clicking on the pinned comment below. If you just want to see the DCF at $180, well, we've used 5% moving forwards. Baked in today is 2% year on year. Overall, though, incorporating all three, a 28% margin of safety. Wall Street themselves see this one. Decent rating, $175 into next year, 33% upside. But let us know, Constellation Brands, is it a buy, hold, or maybe a complete avoid? We then move from one company to an extremely high quality one, that is MSCI. Flat over the last year, year to date down 6%. Over the last 10 years, huge outperformance of the S&P, pretty much banging the midpoint of the 52-week range. Double buy from Seeking Alpha and Wall Street. Now, forward P in isolation is high at 31, but well below their 5-year at 38. Yield a touch higher, 1.3 versus 1. But on the blue tunnel, we do importantly get that disparity. Trading price is the bottom end of the fair value, something that has been pretty much noted in the last 12 months. If we zoom out though, over the last 5 years, what I really like to note is that intrinsically it has been climbing year on year. Over the last few years though, you could be getting this in an undervalued position, something just to bear in mind, but always great to see intrinsically climbing higher. Now, it does trade at a near 200% premium to the overall sector, but as we highlighted, a discount to the 5-year, currently sitting at 23%. And if we look in isolation on the PG, 3 does look fairly high, sector a lot lower, so you are paying a triple digit premium. But actually against their 5-year, you're getting a marginal discount. Like Visa, an incredibly consistent company, near enough double digit projected over the next 4, outperformance in the last 4 quarters, with a forward P projected to drop below 30 in 2026, and their growth grade comes in at a B-, around 11% year on year and projected this year, above the sector, only a little bit below what they have been performing in the last 5 years. Earnings per share though, we note around 11% over the next 3 to 5, in line with the sector, below their 5-year at 13.6. Now, institutions, 90% ownership, selling $7 billion, buying around 50% more. They've also bought more in quarter 2 and quarter 1. Reverse of the trend, you'd have to go to Q1 2024. And if you wanted to see that again, all the way to Q3 2022. More often than not, an institutional favorite. Now, our intrinsic price, $709 from the DCF. Firstly, it highlights baked in already is 11.1. We've used the middle rate of 14%, which as you saw gives rise to a 20% MOS. If you want 25, a buy at $531. Now, Wall Street themselves, 660 into next year, 17% upside. Let us know your views on MSCI. We'll also quickly just flag at the lower end of 12%. You are getting a margin of safety, lower though at 7. If you want to see this at 20%, well, a buy at $487. So let us know on this stock today. We then move on to Advanced Micro Devices, down 5% in the last year. Year to date up 32. Over the last 10, huge outperformance of the S&P, trading towards the upper end of the 52-week range, although it is on a bit of a pullback. Triple buy, first time we've seen this today, right across the board. And whilst it is trading at a 62% discount to the sector on a forward P and a 5% premium to their 5-year average, looking very, very attractive, maybe the most attractive today on a PG basis, 1.33, 28% discount to the sector, but actually historical, it does sit around 1.2, so a bit of a premium around the 11% mark. Growth looking good at an A-, 27% last year, 21 this year. Bear in mind, cyclical industry, around the mid-single digit for the sector, although they were growing faster in the last 5 years, with earnings per share projected 31% in the next 3 to 5, 15%, so a lot lower from the sector, and only a little bit lower than the historical 33%, and very good track record, very good projections, 100% in fact, more often than not, they are in line. Expected double-digit growth at a bare minimum, triple-digit into Q2 2026, and if they hit that EPS, huge jump into the next full year, forward P comes crashing down to 26.5. Now institutions, 71% ownership, selling 22 billion, bought a bit more at 27. They bought around 3 times as much in quarter 2, so they have been bullish in 2025, although they sold more in Q4 2024. And our intrinsic price at $162 is derived using a growth rate of 20%, although near enough, that is what is baked in already at 19.7, so you're only getting a 2% margin of safety. At 10%, a buy at 146, at 20%, 129, and at 25, 121. Wall Street anticipate this to hit $190 into 2026, 19% upside, so do let us know your views. But if you're someone that believes actually we're being way too conservative and we should go at 25%, then you are getting a much higher, clearly, margin of safety at 27%. So let us know your views on AMD as well as the others today if you believe these are a buy, hold or avoid. And don't forget as always to sign up to the free weekly newsletter, grab those spreadsheets, come and join us at Patreon where we cover our buys and sells. And as always, have a great day. We'll see you all on the next one.